If you want to build wealth without stress, without gambling on risky stocks, and without needing to stare at charts all day, then you're about to learn what I consider the most powerful, simplest, and most proven investment strategy ever created. Today, we're diving into the ultimate guide to investing in index funds, the strategy used by millionaires, financial advisors, and long-term investors who want consistent wealth growth with minimal risk. So sit tight, because by the end of this video, you'll know why index funds work, exactly how to invest in them, and how they can help you build long-term, stress-free wealth. Part 1. What exactly is an index fund? Let's start simple. Imagine you want to invest in the stock market, but instead of picking individual companies, Apple, Tesla, Amazon, Meta, you buy all of them at once, automatically inside one single investment. That's what an index fund is. It's a basket of stocks that tracks a specific part of the market, like the S&P 500 top 500 companies in the US, the NASDAQ 100 top 100 tech companies, the total stock market index, nearly every public US company. When the market grows, your money grows. When new companies become successful, they get added to the index automatically, so your wealth adjusts with the economy. That means no stock picking, no emotional trading, no guessing, just steady long-term growth. Even legendary investor Warren Buffett said most people should buy index funds rather than individual stocks. And there was a reason. Part 2, here's why index funds are so powerful. Index funds consistently outperform most professional investors. Yes, you heard that right. Here's why they work. 1. Built-in diversification. You're investing in hundreds or thousands of companies at once. If one fails, another succeeds. Your risk is spread out naturally. 2. Ultra-low fees. Actively managed funds often charge 1% or more per year. Index funds, many charge 0.03% or even less. That difference compounds massively over 10, 20, or 30 years. 3. Market capitalization weighting. Index funds automatically invest more in companies that are performing well. You don't have to pick winners. The index naturally evolves to include the winners. 4. Historically strong returns. Over the last century, the US stock market has returned around 7% per year on average after inflation. That means $100 invested regularly becomes hundreds, then thousands, then tens of thousands, and finally hundreds of thousands or millions, all through the power of compounding. 5. Hard to beat. More than 80% of professional investors fail to outperform index funds long-term. So if the pros can't reliably beat the market, why try? Part 3, different types of index funds, 430 to 730. Let's break down the index funds every investor should know. 1. The S&P 500 Index Fund. This is the king of index funds. Tracks America's 500 biggest companies. Long-term average return, Uruguay 10% per year. Top examples, VOO, Vanguard S&P 500 ETF. SPY, SPDR S&P 500 ETF. IVV, iShares Core S&P 500 ETF. If you want one investment to build long-term wealth, this is it. 2. Total Stock Market Index Fund. This includes everything, large, mid-size, and small companies. It's like the S&P 500, but even more diversified. Examples, VTI, Vanguard Total Market ETF. SCHB, Schwab US Broad Market ETF. According to many experts, this is the easiest way to own the entire US economy. 3. International Index Funds. To diversify globally, many investors also add developed markets, emerging markets, Asia and European markets. Examples, VSUS, Vanguard Total International Stock ETF. IXUS, iShares Total International ETF. This reduces your risk in case the US market underperforms. 4. Bond Index Funds. These add stability and reduce volatility. Popular options BND, Vanguard Total Bond Market ETF. AGG, iShares Core, US Aggregate Bond ETF. Older investors often include more bonds to protect wealth. 5. Dividend index funds. If you want cash flow, these are great. Examples: VYM, Vanguard High Dividend Yield ETF, SCHD, Schwab Dividend ETF. They can give you strong returns plus regular passive income. See Part 4, EMWAR's How to Start Investing in Index Funds. Now let's talk about how you can start investing easily and safely. Step 1. Pick your brokerage. Common platforms: Vanguard, Fidelity, Charles Schwab, Robinhood, ETRADE, Webull. Choose one with zero commissions and fractional shares so you can invest even small amounts. Step 2. Choose your index funds. For long-term investors, a simple proven portfolio might look like 60% S&P 500 or total market index, 20% international index, 20% bonds, optional depending on age and risk tolerance. Or many investors choose to go all in on your one fund, VTI or VOO. The simplest approach often wins. Step 3. Automate your investments. Set up automatic monthly contributions. This is known as dollar cost averaging, where you buy consistently.